Hello and welcome to my morning note. We have a lot of data to look forward to by the end of this week, most importantly the non-farm payrolls from the US on Friday, and we also have to hear a lot from central banks, most importantly the European Central Bank on Thursday. That means there's going to be a lot of switchbacks, a lot of short-term excitement. For today, let's try to put all of this into some broader context. We could be seeing the changing of the tide when it comes to austerity policies, but also a move towards easier monetary policy across the world. That, at least, is the suggestion of my guest today. He's Morgan Stanley's chief international economist, Joachim Fels. Joachim, thank you very much for joining me today. Let's start by taking a look at a chart you prepared, trying to look at the effect of austerity so far on the various countries that have tried it. What would be the main lesson you would draw from this, and what do you expect to see happen to austerity at this point?
Well, John, the main lesson from this chart is the more you tighten the belt on fiscal policy, the more you shrink. So what you can see here is, as countries go to the right of this chart, this means more fiscal tightening, just measured as the change in the structural deficit over a 3-year time period, the last 3 years.
Right.
And you can see Greece is, of course, an extreme example, very tough fiscal austerity, and they're in the south of the chart, so they've had the biggest negative cumulative GDP change. So the lesson is, austerity is really bad for your health.
Right. And the relationship is almost linear. It's an economist's dream, this, isn't it?
That's right. So you can see up on the left-hand chart, you have countries like Japan. Japan actually over the last 3 years had a slight fiscal easing, and they've had one of the best growth along with Germany and the United States. So I think there's a growing realization in Europe that austerity has hit a brick wall. Right. It's reached its limits. The Italian election was a very clear signal.
Right.
So I think we're now getting to the end of the austerity.
Okay, and that would be the case even in Germany?
I think that's the case even in Germany. The election campaign is heating up, and over the last few days it has become apparent that even the German Chancellor now wants to insert some fiscal stimulus after the election. At least that's part of her platform. Spending programs worth about 1% of GDP. So even in Germany, I think the tide is changing.
Now let's take a look at monetary policy. Very familiar chart. The Fed and the European Central Bank have expanded their balance sheets a lot. It just doesn't look like that very much anymore because we've also put the plans for the Bank of Japan on there, which is a quite remarkable expansion coming. The big question I have about monetary policy is the ECB really going to join the party? It has actually tightened its balance sheet a little in the last few months.
Yeah, well, the balance sheet tightening you see from the ECB has happened purely because banks have repaid some of the LTRO money. So the ECB's balance sheet is totally determined by what banks are doing. The ECB opened up its balance sheet to the banks. Banks can borrow as much as they want, and they have the option to repay.
Right.
So I think for the ECB at the moment, the ECB is still very much focused on traditional monetary policy. So they are very much focused on cutting interest rates further.
Could it happen as early as this week?
Well, I actually think it could happen as early as this week. And I think eventually the ECB will probably push the deposit rate, which is currently at 0, into negative territory.
Really? And why would they do that rather than resort to QE first, like the various other central banks?
Well, I think the ECB first wants to try everything that's possible on the interest rate front. Obviously, there are obstacles to QE, mainly public opinion in Germany and the opposition of the Bundesbank. So I think the ECB really wants to use the interest rate weapon as far as possible, including a negative interest rate. But once that has happened, they can argue that, look, we've tried everything else. We've cut interest rates to the lowest possible level. We've even tried negative interest rates. And that then puts QE on the table. So I think that QE becomes an option once interest rates have been reduced further.
And my final question, there's the Fed obviously hasn't been bashful about doing QE. It's now playing a lot of mind games to the market about when it'll start to taper that off. When do you think that'll happen, and how important will the unemployment numbers be for making that decision?
Yeah, well, I don't think the Fed is anywhere close to tapering off. They are talking about it, but if I look at their dual mandate, unemployment is still stuck at around 7.5%. We haven't seen the sustainable improvement in the labor market yet that they're looking for. And importantly, the other part of the dual mandate, inflation, they're increasingly missing their target on the downside. So core PCE inflation is now down to 1.1%. The headline is below 1%. So I think we're getting close to the deflation threshold. That's why I don't think the Fed is anywhere close to tapering off. At the moment, I think December is probably the earliest.
Okay, Joachim, thank you very much indeed. Many people will probably be rather happy to have heard that forecast, but there is quite a lot to be said for the notion that austerity isn't working, and so we're likely to see a retreat from it, but we're not anywhere close yet to the end of easy money.